SMCI stock is up over 17x since the start of 2022, and it begs the question, is the stock really worth the hype? I answer this very complicated question in what remains of this deep dive. So welcome and enjoy. My main conclusion, having studied SMCI for the past month, is that SMCI is far more focused than its two biggest competitors on decreasing time to value and total cost of ownership for AI server customers. This is why it's currently winning and why it will likely continue to win. However, SMCI's exploding capital requirements as the business grows so fast pose a risk to investors, and I'll be covering this towards the end of the deep dive, so stick around for that. Now, let's get into it. SMCI's maniacal focus on increasing the performance and decreasing the cost of AI servers is unmatched. This has afforded the company an earning power that grants the stock vast upside over the long term as AI goes mainstream. I reached this conclusion after an in-depth analysis of the AI server business of its closest rivals, Hewlett-Packard, from now on HPE, and Dell. Although servers are complicated machines, much of the information required to make an investment decision can be inferred by closely analyzing the attitudes of those involved in their creation, refinement, and distribution. I have noticed stark differences between the attitudes of the SMCI, HPE, and Dell management teams. In turn, these differences correlate with the deltas in their respective financials, as you will see coming up next. Before we get into the numbers, to explain what I mean by this, consider that most likely the attitudes of the management teams determine the pace at which the respective value propositions improve over time, aka the management team, which is most focused on the core value drivers of the AI servers, is thus likely to achieve a bigger market share and make more money over time. And ultimately, in this business, customers only really care about obtaining more computation in less time and for less money. In the graph below, you can see how over the last 4 quarters, SMCI's revenue from AI server sales is considerably higher than HPE's and Dell's, and the trend looks much better too. In the 12 trailing months, AI server sales have accounted for 48.6% of all sales for SMCI. Therefore, for the quarters that the company has not disclosed the exact number, I have used this average to obtain an approximation. Moving on to the qualitatives that I believe explain the difference between these financials and that also point to SMCI's competitive advantage. In their quarterly conference calls, the HPE and Dell management teams only really talk about the potential for up and cross sells. They also repeatedly discuss how GPU shortages are slowing down the growth of their respective businesses. Further, in the last earnings calls, both management teams make zero mentions of giving AI server customers more computation in less time and for less money, which is really what customers care about. On the other hand, the founder and CEO of SMCI, Charles Liang, only talks about decreasing time to value and overall cost of ownership for customers. When an analyst asks any kind of question you can think about during the Q&A section in the quarterly conference calls, Charles is most likely to reply simply re-emphasizing the above statement. He just talks about decreasing time to value and decreasing cost of ownership for their customers. Indeed, Charles and SMCI have been doing this for 30 years, while HPE and Dell have only just joined the party. Here's what Charles said during the Q3 fiscal year 2024 earnings call about this.
This fast-growing quarter was driven by end users wanting to accelerate their deployment of the latest generation AI platform. Through our building block solution, we provide optimized AI solution at a scale, offering a time-to-market advantage and shorter lead time over our competition.
It sounds very, very simple, too much to be true, but that is actually how SMCI is winning, and that is why I believe the stock is up big time since 2022. Although Dell looks to be in better shape than HP, they both lack the focus on enhancing the value proposition of the AI servers for customers that is required to compete with SMCI. AI servers are an existential priority for SMCI and seemingly only a strategic one for HPE and Dell. This qualitative impression of mine, which I have gathered by reading all of these quarterly conference calls, is backed up by numbers too. In their latest quarter, Q3 fiscal year 2024, 50% of all of SMCI's revenues came from the sale of AI GPU platforms. In turn, and very much in contrast, Dell's AI optimized server revenue came in at $800 million in Q4 fiscal year 2024. They're actually one quarter ahead, or a bunch of them ahead, which was 3.8% of all sales. Further, AI server orders accounted for nearly 25% of all server orders for HPE in Q1 fiscal year 2024, which sounds great. But in fact, this metric is down from 32% in the previous quarter, which would suggest that perhaps this is not such a big priority for HPE, and again explains why SMCI is actually winning in the market, why customers prefer their products. In my view, this is likely another instance of the innovation stack, when a small company is successfully taking on two much larger companies by being far more focused on the task at hand. However, high-performance computing has historically been a tough industry to make money in, except for NVIDIA thanks to its software moat. In the next section of the deep dive, I analyze the very crucial question of how SMCI is overcoming this challenge in the face of skyrocketing capital requirements. Because sure, it's great that customers demand the products, but ultimately shareholders want the company to make money so that the price of the stock goes up over the long term. And that is actually what we as investors care about. As you can see in the graph below, SMCI's capex has increased spectacularly in the last quarter, and per management's comments during the Q3 fiscal year 2024 call, they will continue rising fast. Here's what David Weigand, the CFO, said during the last call.
The way I would answer that is that I hope that I need more capital, John, because that means that we're growing revenues even faster.
So SMCI's capital requirements are indeed exploding as the business grows, but my view is that shareholders will likely do well if SMCI finds a way to increase operating leverage regularly. Increasing operating leverage with a regular cadence will likely enable SMCI to buffer the rising capital requirements within reasonable limits. SMCI is already succeeding on this front thanks to its server building block solutions architecture, which allows them to more rapidly iterate, personalize, and deploy their servers. This modularity is the source of SMCI's time to value and cost advantage that Charles Liang mentions so often. I know for a fact, regardless of Charles' comments, that SMCI is successfully increasing its operating leverage because its margins are trending up when the scenario is far less favorable for its competitor Dell, as I will explain coming up next, which is in fact in far better shape for AI servers than HPE in my view. Additionally, net income is growing exponentially, which suggests that SMCI has no trouble with scaling the source of its operating leverage, with both the top line and the bottom line growing exponentially. Now, about Dell, which is a key piece of information because the relative analysis is really what allows me to see into SMCI's competitive advantage. Reading Dell's latest earnings call transcript, Q4 fiscal year 2024, I noticed that the company was guiding for lower margins next quarter as AI servers became a bigger part of the mix. During the quarter, AI accounted for only 5% of overall revenues, but management was guiding for margins to decline 100 basis points quarter over quarter. An analyst remarked during the call that for such a small business volume to drive gross margins down so meaningfully, AI margins had in fact to be highly detrimental. The CFO's response was inconclusive and diluted, which in my view again points to SMCI's competitive advantage at present. The modularity of SMCI's architecture will continue to pay dividends so long as SMCI remains focused, with competitors seemingly far behind and actually focused on other businesses. My impression is that HPE is most focused on networking with the acquisition of Juniper Networks, and Dell seems to be quite keen on AI PCs. Further, I notice a cyclicality in the progression of gross margins similar to that of Tesla's, which I've written about previously. I therefore suspect that SMCI is periodically decreasing prices every time it attains a new efficiency threshold, thus passing back efficiency gains to customers in the form of lower prices. I have not actually seen management talk about this, but I will look for a confirmation of this hypothesis going forward, because sharing economies of scale makes it even harder for competitors to gain market share, thus strengthening the moat, which ultimately increases the odds of free cash flow per share levels going up as the revenue of the business grows. This may actually also be due to competitive pressures, but I need more time to be sure. Over the long term, SMCI can exponentiate its operating leverage and the strength of its moat by creating network effects via the advent of an operating system, as you can see in the graph above. Making money in the high-performance computing market is difficult because development costs are high and the market is relatively niche. You don't have the whole world buying high-performance computing, only a relatively small part of the economy, which makes selling hard. Network effects can make selling easier for SMCI and harder for competitors, which should meaningfully increase the power of the business. As I was saying, SMCI can develop network effects by creating the default operating system for proprietary data centers. Next-gen data centers are stateful, meaning that they hold information about their state. This data can then be used to train neural nets in order to automate processes within the data centers themselves. If SMCI manages to create a software architecture that is analogous to its already successful hardware architecture, much higher levels of operating leverage will ensue, NVIDIA style. NVIDIA is a prime example of how to exponentiate operating leverage in the semi-space via software. By making it painless for developers to interact with NVIDIA GPUs via CUDA, it grants its GPU installed base with network effects, because CUDA effectively connects all of the deployed NVIDIA GPUs and turns them into a network. Every additional GPU sold makes the network bigger, which then funnels more capital towards NVIDIA, which then helps the company make CUDA better, and so on. About the financials, the biggest concern that I have is that assuming its organizational properties remain, SMCI's financial health depends on the ability of AI models to generalize as we add more parameters to them, and we actually have no certainty that this relationship will hold over time. However, my view, per my understanding of AI, having spent 2 to 3 years only studying neural networks, is that this relationship will likely persist. SMCI's financial performance is primarily a result of folks wanting their own data centers to run AI operations, coupled with the aforementioned operating leverage, because that is how SMCI turns revenues into profits. This desire has been driven by the relationship between the number of parameters in a model and their ability to do things we didn't actually train them for. In the graphs below, you will notice that the inflection point in SMCI's revenue yearly coincides with the inflection point in the number of parameters for milestone models across the board, and not just for language models. As the number of parameters in these models continues to grow exponentially, the data used to train them is gradually becoming the most important asset for organizations, perhaps after their people, but perhaps soon enough, even more than their people. This is what is driving the demand for SMCI servers and ultimately for proprietary data centers. The industry knows how to continue exponentiating the number of parameters in these models. It is an engineering challenge going forward and not a scientific discovery challenge as it has been in the past, and that is the reason for which we've had AI winters. For this reason, I believe that continuing to exponentiate the number of parameters in these models will not be a roadblock. So long as the relationship between the number of parameters and the intelligence/ability to generalize holds, folks will likely continue demanding proprietary data centers, in my view. However, and this is very important, this does not mean that SMCI will not experience inventory corrections, or that the evolution of AI will be a straight line up. AI may well go through a dot-com phase, and my analysis is framed within a 10-year plus investment horizon, which I always recommend all of my readers and all of my students to think very long-term when investing, and particularly so in tech, because you never really know when you can get caught up in something like the dot-com bubble, regardless of the underlying fundamentals of the company that you've invested in doing very well. The market can stay irrational for longer than you can stay solvent. Going back to the models, I believe that the intelligence of these models will continue going up over time, with organizations taking more measures to protect the data that fuels them and not less measures. Additionally, just over 50% of SMCI's demand is driven by GPU servers, which companies use to train models. SMCI's top line, therefore, has considerable upside as AI inference gets even bigger than AI training, which I believe is going to start happening over the next year. As I explained previously, but this is worth remarking, the ultimate proof of SMCI's advantage in the market is how both the top line and the bottom line have scaled with the onset of these larger models, while competitors' margins are seemingly faltering. Operating and net income are rising in tandem with revenue, proving that SMCI's building block solutions architecture is structurally superior to alternatives. About the cash flow statement, SMCI experienced a significant drop in cash from operations in the last quarter, primarily due to the increase in inventories and accounts receivable. In Q3 fiscal year 2024, the company, as a result, reported a cash outflow from operations of $595 million. This is a great source of uncertainty in the thesis, because if SMCI could scale its business without declining its cash flow production, then it would really be probably a 10 out of 10 thesis, and would only really depend on whether people continue demanding proprietary data centers or not. But with cash flow dwindling as CapEx is going up and as the business scales, then this adds additional uncertainty, which I think is hard to see through. Further, SMCI is expanding its manufacturing capabilities with a new factory in Malaysia. This facility is part of a broader strategy to enhance the global manufacturing footprint and increase production capacity. The cost of the Malaysia factory is estimated at $800 million, which adds to the weight of the rising inventories. About the balance sheet, as of Q3 fiscal year 2024, SMCI had a robust net cash position. The company reported cash and cash equivalents of $2.1 billion following an issuance of convertible notes amounting to $1.7 billion. So much of that comfortable net cash position comes from the issuance of these convertible notes. Now, my conclusion after having done this deep dive is that SMCI has excellent engineering, but the execution going forward is quite uncertain. I need more time to be certain, but I believe SMCI has a clear competitive advantage versus HPE and Dell. This is visible in the remarkably superior focus of the management team on AI servers and on the aforementioned scalable income statement. I suspect that actually both HPE and Dell are years away from having anything that resembles SMCI's modular architecture. So long as the demand for proprietary data centers persists, this competitive advantage can lead to considerable top-line growth for SMCI. However, the cash flow statement and the balance sheet are murky. Management is now faced with the task of deploying amounts of capital that are unprecedented in the company's history. Initiating a position now requires making an assumption about management's ability to do just that. At the moment, while I know that I can rely on SMCI's engineering excellence, I do not have enough information to assess their ability to scale the operation into the big leagues. As mentioned previously, SMCI's modular architecture will be a big tailwind which should help SMCI buffer much of the capital requirements and mistakes it may make along the way. Over the coming quarters, I will be analyzing the company closely to learn more. Now, just to wrap up, if you enjoyed this deep dive, I'd like to ask you for one favor. These deep dives are for free, and the only way this grows is with your help. So if you could please share this with one friend that you think would enjoy this deep dive too, I would be really, really grateful. So until next time, and take care.